Good morning. It's Jeffrey Christian of CPM Group. Welcome to our 2025 Silver Yearbook and Market Review. We're going to talk about where the market was last year, where it is this year. We've been producing Silver Yearbooks and surveys really since the early 1970s when we were the research department at J. Aron, since 1986 when we spun out of J. Aron Goldman Sachs and created CPM Group. That was the 30th of May, 1986. So we're coming up on our 39th year as an independent research company. I want to start by thanking our sponsors and partners. We have a Chinese partner, which is the Shanghai Huatong Silver Exchange. That is the physical market for silver and platinum group metals in China. Similar to the Shanghai Gold Exchange for physical gold. And then we have a number of partners and a number of sponsors and a number of new sponsors this year. We want to welcome Alaska Silver and Allura Resources as new sponsors. These are silver exploration and pre-development companies. Very interesting companies. Actually, I guess Alaska Silver is the development company looking to reopen some mines that operated a quarter of a century ago in Alaska. And Allura has a very interesting tin and silver property in Bolivia. We also have the Bulgarian Mint, which is a major producer of blanks for national mints and others, as well as its own medallions and bars that it produces in gold and silver. They have been a sponsor for several years now. The Institute of Scrap Recycling Industries, which represents scrap recyclers in the United States, including precious metals. Kitco Metals, precious metals refinery in Montreal. Coralin Economics reports Metallic Minerals Corp., which actually is a umbrella for three companies that have various exploration and pre-development companies. Monex Precious Metals, which is one of the best and longest running and largest precious metals retailers in the United States. CPM Group does a lot of work with Monex, and we have worked with them since the 1980s when they were created and CPM Group was created. Actually, I think we probably worked with them before CPM Group was created when we were still at J. Aron Goldman Sachs. Cinda Silver, silver mining company under the Electrum Group. Pan American Silver Corp, I think, needs no introduction. Sabin Metal Group, which is primarily a gold and platinum group metals refinery, but it does do silver as well, refining from a variety of industrial secondary materials. Silver Corp Metals, again, large silver company, very interesting silver properties in China, but is also expanding to other countries around the world and is a major producer of silver. Southern Silver Exploration Corp., exploring for silver. Sunshine Silver Mining, another Electrum Group company, looking to reopen the Sunshine Mine in Idaho, the Electrum Group. So a wide and diverse group of sponsors helping to underwrite the costs of producing this yearbook and allowing us to offer it to people at a lower price than some of our other research. We also have media partners, Glacier Publishing, Kitco, Metals Daily, Minera Andina in Peru, Proactive Investors and Prospector News. And we have distributors that also help distribute our information around the world. CGS Events, Gold Blocks, Gold Silver Central, which are in Singapore. Intro-Act, provider of research across financial markets. The Prospector News, Southeast Asia Consulting, the David Lynn Report, and Fortel Private. So we have a number of companies that help distribute this information. We've always strived to produce the most accurate data on precious metals as well as unbiased analysis there. And I think we have a track record to prove it. We will have a question period at the end. If you have a question, you can go to the dashboard and there is a section that's called questions, and you can click on it and type in the questions, and hopefully we'll be able to read them and see where we go with that. I'll speak a little bit about the prices of silver and inventories, and then I'll pass the baton over to Rohit Savant. Rohit's our executive director, partner in charge of the precious metals research, and the primary author of most of our precious metals research. Carlos Sanchez and I help him with various aspects of the reports, but he is really the primary author, and he'll talk about the supply-demand fundamentals and the outlook for precious metals. We'll come back and talk a little bit about inventories at the end and open it up for questions. And Carlos, hopefully, or Elliot Carlson will help me hear the questions. So the silver price, it's an auspicious day today to be speaking about silver, because silver fell sharply this morning. It got down as low as $32.88. As we were starting this, it was at $33.17, which was off about 44 cents. Gold also declined, and oil, and the stock market was up. The U.S. stock market was up in the pre-market. The dollar was mixed, and interest rates were also mixed. So we're seeing a continuation of the uncertainties and the heightened risks in the financial market, in the financial system, global economics, and politics. And all of that has been driving gold and silver higher with stronger investment demand, which we'll talk about later. But the heightened uncertainty has gotten to a point where you're seeing large heightened volatility in gold and silver prices. Silver last year averaged $28.41 last year. That actually is a high price. There are a lot of people who think that silver should be much higher. But if you look at the economics of mining silver, refining and recovering silver from scrap, everything from jewelry and decorative items to electronics and other industrial products, if you look at the costs and economics of using silver in fabricated products and the relative value of silver to other assets, you'll see that silver prices actually are highly priced. And they also are priced at a level where probably a lot of investors have been taking profits over the last couple of years. This is the price of silver since 2019. And you can see that the price of silver came into 2019 trading around $16 an ounce. It spiked up in July and August of 2019 and then came back off. When we got into COVID, it fell sharply, briefly. There was a lot of dislocation of all sorts of goods around the world, and silver fell briefly to below $12, but it came back, and then as 2020 progressed, it rose sharply into that $24 to $28 range. It stayed in that range for several years, came off a little bit in 2022 as the economy was strengthening. And you also started to see some stable liquidation. People who had bought into or believed the scams, the Wall Street silver scam and the silver squeeze scam, those were really scams by promoters looking to get investors to buy silver based on irrational expectations of sharply higher prices sooner. And you started to see stable liquidation really in the second half of 2021 already, but then it really amplified in 2022 and actually continued through 2024. One of the factors that we've seen is investors selling offsetting investor buying. Other investors have been buying over the last several years, but some of the silver they're buying has been sold by investors who were disenchanted by expecting much higher prices sooner and paying higher prices, and in many cases inflated prices in that 2021 scam fest. Silver prices, as I said, averaged $28 last year, $28.41. That was up 20.7% from 23.53 in 2023. And it continues to rise. So far this year, the price has been averaging $32.38. So it's over $30 on an average price in the first 4 months of the year. That was up 31% from the same period in 2024. The range last year was $22 to $35.04. The range in the first 4 months of this year has been $29.23 to $35.08. There is an upward bias to the price there. My next slide is a longer term price slide. And I said earlier that while a lot of people think that silver prices are undervalued, silver prices are actually relatively high priced. And you can see that here on this chart. This is a chart going back to 1975, monthly average COMEX nearby active contract. You can see a very brief spike up to $37 on a monthly basis in early 1980. And you can see another spike in 2011 during the tail end of the global financial crisis, the tail end of the Great Recession, at the beginning of a couple years of sovereign debt crises, both in Europe, especially in the southern tier of Europe and Greece, and in the United States, which in August of 2011 saw the first downgrading of Treasury security credit ratings in the history of the United States. Silver spiked up in April of 2011. It came back off, and then it continued to decline in 2020, 2012, and 2013, moved sideways for a while. You can see that the price now is back above $30 on an average basis year to date. And the price has been trading between $28 and $34, $35. And that is actually a relatively high price in the history of silver prices. So it's something to pay attention to, a reasonable expectation. The last slide I will talk about is above ground refined silver bullion. We measure this as refined silver bullion in bar form and in coins form. The bars include 1,000-ounce bars, and they also include smaller bars, investor bars, 100-ounce bars, 10-ounce bars, medallions, which are rounds, typically 1 ounce, that are not produced by a national mint. Official coins are produced by a national mint. Medallions, which some people call coins, are not produced by a national mint and don't have a government standing behind them. That bars and smaller bars and medallions get included in what we call bars here. And you go back to the 1970s and 1980s, you can see that our estimates were 5.5 billion ounces of refined silver in above ground inventories, mostly in implied unreported stocks. This is data that we have, some of it going back thousands of years. We have cumulative mine production, secondary recovery, fabrication demand, and investment demand in our Silver Yearbook in the Review and Outlook. We have this data going back through antiquity. Most of the production has been since the Industrial Revolution, circa 1850, and it has been relatively regular. We have calculated the supply and demand over time, and we have good data that suggests that going into 1970, about the time our research operation was formed, there was probably about 4.8 billion ounces of silver in refined inventories that were unreported. Some of them were corporate fabricators and refiners. A lot of it was held by banks and merchants who lent it out to fabricators. And a lot of it was held by investors. Now, starting in the mid 80s, we saw official coins being created. I'm proud to say that we were involved. I was personally involved in creating uh, and organizing the silver eagle in the United States and the silver maple leaf and the silver coins um, in both Austria and Australia, as well as in other countries, including China. And we saw the maple leaf and the eagle as the two most prominent coins. And you started seeing investors buying these coins. They were selling their unreported inventories and buying coins. And because it's governments, we have pretty good annual data. And we know that between, say, 1984, when this all started, and now, 2.55 billion ounces, 2,550,000,000 ounces of silver have gone into official coins that were purchased by investors. So that top green stuff is coin holdings mostly held by investors, 2.5 billion. And you saw that investors started selling some of their unreported bullion bars and buying those coins because they were a preferred way for investors to own gold or silver. At the bottom of this chart, you see a purple area that started to emerge around 2005. That's exchange traded products, mostly exchange traded funds, but there are some non-fund notes and other structures that are traded on the exchanges. And again, that became reported inventories. And as of the end of last year, exchange traded products held about 997.6 million ounces of silver, nearly a billion ounces. It has gotten over a billion. These are the ETFs and ETPs that hold physical silver. There are other exchange traded funds that don't hold physical silver, but they'll trade silver derivative products and give you investors exposure. But these are the actual ounces of physical silver held by those exchange traded products that hold physical silver. And again, you see that that led to a decline in the amount of unreported implied inventories of bullion. So what we've seen really since the 1980s is an increase in transparency of inventories. We now have about 6.48 billion ounces of silver estimated to be in above ground inventories. Almost all of that, well, maybe 70% or more, are held by investors, right? There is perhaps as much as a billion ounces that is held by the trade, mostly banks and trading companies that hold metal and lease it out to mining companies, smelters, refiners, and fabricators, and other companies that are involved in producing or using or investing in silver, but for financial reasons don't hold those inventories as owned. They lease it out. But the vast majority of this silver is held by investors. And you'll hear people say, well, yeah, the investors will never sell. But as we've seen over the last 2.5 years, there are always investors who are willing to sell. There are other investors who'll say, oh, well, my average acquisition price for my silver holdings is probably around $5 an ounce. Might I sell at some point? Yes, I might, if we ever have an ethical and efficient government in the United States. But right now, I'm holding that. And you'll hear people say, well, these investors will never sell it. But the reality is that the investment market is a two-way street, and there's always a lot of silver being sold as well as being bought by investors, right? And one of the things that we've seen over the last couple of years is that net investment demand has been reduced by the fact that you've had this disenchanted selling. Hopefully, Rohit will talk a little bit more about this. There's one point that I want to make about this. If you go back to 1979, when the price of silver went from $5 to $50, our estimate was there was 4.5 billion ounces of refined silver in above ground inventories, mostly held by investors. And we saw 100 or 200 million ounces of silver sold at that time. So a fraction of the silver, but a significant amount of silver vis-a-vis the annual supply and demand of newly refined silver into the market and out of the market into fabricators and investor hands. Right? So you saw that. But the important thing is the price rose tenfold from $5 to $50 in the face of 4.5 billion ounces. Investors continued to buy silver, expecting the price to go back to $50 any moment over the course of the 80s. As the 80s turned into the 90s, investors said, well, maybe that was a flash in the pan. We're in a new economic paradigm. Inflation has been killed. Stocks and bonds are doing incredibly well. Overall economic conditions are doing well. The Soviet Union has dissolved into Russia and 15 other independent states. Eastern Europe has gained its independence from the former Soviet Union. There's less reason to hold silver and more reason to be investing in stocks and bonds and currencies. And you saw investors sell silver collectively get down to about 4 billion ounces by 2005, when the price was about $5 an ounce. And from 2005 into 2011, the price rose from about $5 an ounce to $50 an ounce in April, at the end of April 2011. You had 4.5, 5.5 billion ounces of silver that did not preclude the silver price rising. Very important to remember. Yeah, you look at gold, you have several years worth of above ground inventories. You look at silver, you have several years of above ground inventories. You look at industrial metals, copper or base metals, and you'll find that you have, the difference between a bull market and a bear market and a base metal might be the difference between 2 weeks of inventories and 6 weeks of inventories. Those inventories are working commodities, industrial commodities that are used and not held by investors. Gold and silver are used in fabricated products, but the bulk of it is also held by investors. And that's a very important factor to remember. I'm going to turn the screen over and the microphone over to Rohit at this point, if I can figure out how to do that.
So last year we had net silver investment demand get to about 70.2 million ounces, which was up pretty sharply from 42.2 million ounces in 2023. And that sharp increase in silver investment demand was reflected in the price of silver. So you had silver prices rise around 25% over the course of 2024 when you compare it to the end of 2023. There was a lot of reasons why investors were buying silver last year. There was the potential various risks, both political as well as economic. There was some concerns about how long the relatively good economic conditions in the US could be sustained. You had record high equity prices, which had many investors consider opting for portfolio diversifiers like gold and silver as a hedge against those high equity levels. You had softening inflation, but it was still high inflation compared to where it's been in recent decades. And then you had elevated political tensions pretty much across the globe. So there were a lot of reasons why investors were buying silver last year. One of the main headwinds to silver investment demand, as Jeff mentioned multiple times, was selling by past silver investors, or what we'd call stable liquidation. So a lot of these investors bought silver with expectations that silver prices would retest levels that were seen in 2011 or potentially even break past those levels. That hasn't happened so far, and that's obviously left a lot of investors disappointed in the market. And so when you do see price rallies, as you've been seeing in recent years, there's been selling into those price rallies. So that's limited the pace at which silver prices have been rising, as well as the net increases that we're seeing in silver investment demand. We expect this selling by past investors to continue in 2025 as well, but we think that the intensity of that selling will reduce, in part because a lot of the selling has already occurred, and also because a lot of those potential economic and political risks that were worrying investors last year, they're worrying them even more so this year. So there's more reason to be buying and holding portfolio diversifiers like gold and silver. So we expect that a lot of that selling will reduce. That said, every time silver prices get to key technical levels like $34, $35, you're probably going to see some selling, which could weigh on net investment demand. But we do think that that selling will reduce, and that overall, over the course of the year, that net silver investment demand will rise, and we're expecting that it would rise to about 134 million ounces this year, which again should be supportive of silver prices at elevated levels, with the potential for them to rise further over the course of 2025 and beyond. In addition to the various political and economic risks that have been driving investors towards silver, the price of silver is also very attractive on a relative value basis compared to gold. So at this time, gold is about 100 times more expensive than silver. And given that there are a lot of reasons to be buying these portfolio diversifiers, there's going to be a certain amount of investor interest in buying this relatively less expensive metal as a potential hedge, or as a hedge against potential risks in the portfolio. So after 2 consecutive years of net selling by ETFs in 2022 and 2023, last year you had ETF investors turning net buyers. They added about 35.5 million ounces of silver to their holdings, which was a small amount. It was the smallest amount of net additions since 2005, but it did help to reverse some of those declines. It reversed about 20% of the declines that were seen over the previous 2 years. So there was some help from that net addition. And a lot of the weakness that we saw in 2024 came in November and December post the US election, when there was a general selling of safe haven assets like gold and silver, and an increase in equity markets and other risk assets. So we do think that trade will, there was a bit of an unwinding earlier this year, and we do think that as the year progresses, that unwinding would continue and would stand to benefit assets like gold and silver. Silver coin demand declined for the 3rd consecutive year last year, but it was still at fairly high levels. Again, investors were interested in buying silver, but the high price of silver, these coin investors have typically tended to be very sensitive to high silver prices. So when you see prices rising strongly, they do tend to pull back on making fresh purchases. And a little bit of that was seen last year and has been seen over the past few years, which has been holding back coin demand. But that said, because there are reasons to be adding silver to your portfolio, you have been seeing the overall level of demand is still fairly high compared to where it's been historically. So silver fabrication demand reached a record high last year. It stood at 986 million ounces. It was the 4th consecutive year that silver fabrication demand rose, but the pace of gains had slowed substantially last year. So a lot of the gains that we've seen over the past 4 years have actually been driven by the solar industry. and demand for silver from the solar panel industry. You've had governments as well as the private sector focusing on meeting their green energy targets using solar power. You've had a sharp increase in solar panel production, which has been actually in excess of the level of installations, and that's weighed on prices, making it one of the most affordable sources of green energy. And then you've also had the introduction of silver-intensive solar panel technologies. So all of these factors collectively have helped silver demand from this source, and solar power has been the driving force behind this increase in silver fabrication demand that we've seen over the past few years. Last year, in addition to the solar industry, the electronics industry also helped to provide some support to silver fabrication demand. But outside of these two sectors, silver fabrication demand was actually declining in most of the other sectors, which is why the total rate of growth for overall fabrication demand was fairly small last year. In 2025, we're forecasting silver fabrication demand to slip to 959.4 million ounces. And that weakness in silver fabrication demand this year is based primarily on the expectation of weaker economic conditions as the year progresses due to the trade tensions that we're seeing currently, as well as the high price of silver. If this level of silver fabrication demand actually materializes, that would be the lowest level of silver fabrication demand since 2021. So in 2024, the solar panel industry consumed 206.1 million ounces of silver, which was roughly double the 103.8 million ounces of silver that this industry used in 2020. We expect demand to continue rising in 2025, but the growth, we think that the growth would be a lot more moderated this year compared to what it's been in recent years. And one of the primary headwinds to silver demand from the solar industry is the excess production of panels relative to installations. So what that is doing is it's resulting in a lot of the new demand being met by inventory. It's also depressed the prices of solar panels, which is now squeezing the margins and has been squeezing the margins of solar panel producers for some time, which is forcing them to focus on thrifting out silver use in these panels. So both these factors collectively this year, we think, will act as a headwind to silver demand from the solar industry. So that said, we do think, or rather we expect that solar panel production will continue to rise, and the thrifting effort is not fully in place at this point. So the impact is not expected to be as negative as it could potentially be in coming years. So last year, silver jewelry demand declined to 291.3 million ounces, which was a roughly 2% decline from 2023 levels. The high price of silver, weak economic conditions in some countries, relatively high inflation in other countries were all factors that collectively weighed on silver fabrication demand from silver, from jewelry. The one factor last year that did help support silver demand from the jewelry sector was India. In the case of India, you saw a sharp reduction in import duties from about 15% to 6%, which resulted in a jump in the restocking of silver by jewelry fabricators. You also had a healthy crop last year, which boosted incomes in the rural areas, who are the primary buyers of silver jewelry. So both these factors together helped to push up silver jewelry demand in India last year and helped to offset some of the weakness in other markets. This year, we expect silver jewelry demand to decline to 272.5 million ounces. And that weakness is primarily, again, driven by that expectation of weaker economic growth. Jewelry demand is income sensitive. So weaker economic growth would, and it is a discretionary purchase, so weaker economic growth would push jewelry demand on the back burner. And you also have an expectation of higher silver prices in 2025, which would again be a factor that would act as a negative to silver jewelry demand during the year. So after 2 consecutive years of declines, you did see silver demand from the electronic sector rise in 2024 to 231.6 million ounces, which was a 2% increase from 2023 levels. The demand last year was helped by the AI infrastructure build out. You had strong BEV sales in certain markets. You also had higher auto production overall globally in 2024. And after 2 years of weak demand, there was an uptick in consumer electronic demand in 2024 as well. So all these factors collectively helped to push up silver demand from the electronic sector last year. This year, the same weaker economic conditions that we are expecting, we think would act as a headwind to electronics demand, especially consumer electronics and spending by businesses. Among businesses, we do think that there would be an increase in spending on the AI sector, but a lot of companies are reassessing the amount of spending that they want to do on the sector. So while we do expect growth and strong growth, it may not be as strong as it was expected last year. We also have BEV sales. We think that they would be strong in certain markets like China, but there is weakness expected in other markets like in the West, in the US or in Europe, which would act as a headwind as well. Overall, in the US, we think that auto demand would decline due to the increased tariffs. So that again is something that would act as a headwind to silver demand from the electronics that are used in the auto sector. And then on the positive side, you do have the upgrade of Windows 11 coming in later this year, which could provide some uplift to consumer electronic demand. But that would depend largely upon how the economy is doing, and how much of a positive impact that might have would depend on how well the economy is doing in the second half of 2025. So total supply in 2024 stood at 1.06 billion ounces. This was the highest level of total supply since the record that was reached back in 2016 of 1.08 billion ounces. This is total supply is both mine supply as well as scrap supply. And last year, both these sources of supply helped to boost total supply. Now, while mine supply accounted for the majority of the gains that we saw in 2024, it was still lower than the levels that we saw in 2016. And there are a combination of factors that have been weighing on silver mine supply. For one, in recent years, you've seen some major mines being either suspended or closed for a variety of reasons. You've seen a decline in the number of new mines coming on stream because of reduced investment in the sector. So both these factors together have contributed or weighed on mine supply in the past few years. Scrap supply rose strongly last year. You had the higher prices, which generally tends to be a positive for scrap supply. And you also had increased recovery of silver from certain industrial uses. So you did have higher silver being recovered from the ethylene oxide industry. There you did see an increase in the flows from ethylene oxide catalysts, because during the 2019-2021 period, you had seen a substantial increase in the amount of new ethylene oxide catalysts that were being built. And these catalysts typically tend to be recycled within a 3 to 4 year period. So most of what was being built back then came back into the market last year and helped to provide some support to silver recovery from that source. You also had an increased amount of electronic scrap, the high price, as well as the increased regulation on how end-of-life electronic scrap is dealt with, were both factors that helped to boost silver recovery from the electronic sector last year. This year, we project total supply to reach a fresh record high level of 1.09 billion ounces, and that increase is expected to come from both an increase in mine supply as well as scrap supply. So last year, you had 3 new silver producing mines that came on stream, which added around 7 million ounces of new silver mining capacity. The new silver mining production capacity is projected to reach 16.6 million ounces in 2025, which would be the highest that it's been since 2016, when it stood at 19.1 million ounces. So while there's an impressive amount of new capacity expected to come on stream this year, if you take the 3-year average between 2023 and 2025, that average is around 7.8 million ounces, which is just a little bit higher than the average between 2021 and 2022, which stood at 7.3 million ounces. So since 2021, on average, you have about 7.5 million ounces of new capacity coming on stream. That's where it seems to have stabilized for now. But that amount is substantially lower than the peak that we saw back in 2013, when it stood at over 35 million ounces. So this reduced amount of new mine capacity has been one of the main reasons for mine supply not being able to grow substantially in recent years. And that a new mine capacity reduction has to do with a lower investment in the mining sector, which has also been an issue that's been in place for some time. So you have been seeing some increase in investments in the mining sector in recent years, in the past 2-3 years. But the lead times for bringing these mines on stream has also increased, and now it stands at around 18 to 20 years, because of the amount of regulations that are in place to bring mines on stream. So any increased investment that we've been seeing in the past few years, we're not likely to see the mine supply being impacted positively from that for nearly 2 decades from now. So mine supply is expected to sort of move sideways over the next few years, which is a factor that would again be supportive of silver prices. So production-weighted cash costs from primary silver mines last year was essentially flat. It was at about $11.44, which compares to $11.43 in 2023. And there were a couple of counterbalancing factors that helped to keep costs in place. The one factor that did push costs up was the higher silver price, which does tend to result in mining companies focusing on their lower grade ores, which tends to typically push up cash costs. And also higher metal prices typically tend to push up input costs as well for those products. So the higher silver price was a factor that put upward pressure on costs last year. But the overall moderation in global inflation, coupled with higher byproduct credits during 2024, were 2 factors that put downward pressure on costs. So negating some of that upward pressure caused by higher silver prices. This year, we think that a combination of higher silver prices and the potential for inflation to come back again, possibly rising in the second half of the year and beyond, is something that could result in cash costs for mining companies inching up during 2025. So with that, I'll pass this back to Jeff to speak about inventories.
Thank you, Rohit. Thanks. Investment demand. I'm sorry. I thought that I had gone further. I want to talk about inventories. They have become a subject in the markets. You have seen COMEX silver inventories rise sharply to record levels. This chart only goes back to 2003, if you take it back to the 1970s and 80s and 90s, you'll see that we had maybe 200, 250 million ounces of eligible and registered stocks in the COMEX depositories. I think there's a lot of misunderstanding about what the depositories are and what the stocks are. Eligible stocks were only reported after 1988. There are differences in regulations between the COMEX and the London Bullion Market Association. On the COMEX, you only get reports of what is deliverable to COMEX that is stored at depositories that are registered with the COMEX and with the COMEX clearinghouse to take delivery and hold metals for that. There are additional inventories of silver in coin form, medallion form, smaller bars, 100-ounce bars that will appear in those depositories, but it doesn't get reported. COMEX registered stocks are the stocks that are in COMEX registered depositories, the warehouse or depository receipt of which has been delivered to the COMEX clearinghouse for use as collateral against positions on the COMEX. If you are buying or selling futures on the COMEX, you have to put up margin. You can put up margin in cash, in treasuries, and in silver, and in some other assets too. And those are registered stocks. Eligible stocks meet the COMEX delivery specifications, including the 1,000-ounce shape. They are refined by COMEX recognized depositories, and they're not registered with the clearinghouse. The act of registering is a matter, these days it's an electronic, click of a button on your keyboard to say to the clearinghouse, I have this silver in this depository. Here is the depository receipt. And now I can use it as registered inventories against my margin requirements. And you'll see it goes back and forth. You cannot take, so that's where you see it. Going into the century, you saw that COMEX registered stocks and eligible stocks were trading, averaging around 50 million ounces or less for registered stocks and around 100 to 150 for total inventories. They started to rise after the Great Recession and global financial crisis. And most of the increase was in eligible inventories, silver moving into the United States from other places. You saw a period of somewhat slower fabrication demand, so there's a buildup of inventories. The rate of increase in eligible inventories and in registered inventories rose sharply from 2017 to 2021. The first part of that reflected changes in where the silver was being bought by investors and used by fabricators, more so in North America than in Europe. And the second part had to do with COVID and financial and economic dislocations that occurred there. You saw an increase in 2021. Part of that was in response to the silver squeeze scam and Wall Street silver scam. But that ended and it came back down. But when it came back down, it stayed above 250 million ounces total inventories. Started to rise a little bit in 2023, 2024. And earlier this year, it rose very sharply to a record 500 million ounces. There are several questions that we've gotten about the relative strength of gold and silver. The reality is that silver is much more of an investment product in North America and South Asia than it is in other parts of the world, such as Europe. So that there is a tendency for trading companies and bullion banks that trade silver to hold their metal in North America or South Asia because that's where the demand is going to be. So when it comes time to sell your material, when somebody comes and says, I want to buy silver, um, you're at a little bit of an advantage if it's in North America. And we're seeing that now. So we've got large inventories in COMEX. You're seeing depositories built year after year. This is something that really goes back to around the time of the global financial crisis and Great Recession, where you started to see inventory depositories running out of space to store silver and gold and building depositories after depositories. So a lot of the depositories have quadrupled and quintupled their storage capacity over the last 15 years. It's interesting because during that period of time, you had people saying that the world was running out of silver, but the depositories are saying, well, we have more than ever before. A lot of it's now in COMEX. I should say that the COMEX depositories are within a capture area a certain distance from New York City. So it represents metal that is in the northeastern United States, basically between Delaware and Massachusetts. There are other depositories around the country, Nevada, California, Florida, Utah, Idaho, Utah, that have large amounts of silver and gold stored in addition to that, but they are not in the COMEX depository capture area, so they don't get reported. In Shanghai, they started trading silver around 2012, and you saw a surge of silver during the COVID. It's come back down, but it is still around 30 million ounces. And these are Shanghai Futures Exchange silver inventories. They have a very similar situation. These are not inventories that are held by the Shanghai Futures Exchange. These are inventories that are stored in depositories around China that are registered with the Shanghai Futures Exchange. And again, there are many other depositories that aren't registered with the Shanghai Futures Exchange that hold silver in China. So there's a sizable amount of silver in China. And then these are the London inventories. The London banks and depositories that all form the trade association, the London Bullion Market Association, did not report their inventories until the middle of 2016. They began reporting them in 2016. If you recall this slide 2 slides ago, you saw this increase in COMEX eligible inventories and reported inventories in this period, 2016 onward. You saw a similar increase in London. Then it kind of plateaued. 2019, there was a surge during COVID. It came back off in 2021, 2022, and it's down again. It's down to 700 million ounces. That's almost a year's worth of fabrication demand. So there's a tremendous amount of silver. As I said earlier when I was showing you the inventory data, there's a tremendous amount of silver that's above ground, that's reported and unreported. With that, I'm going to open it up for questions. And I can read some, and if I start fumbling, Carlos or Elliot can help me. You can buy our book. You can go to our website and download it. It comes out as an ebook. It's $160. We also have a gold yearbook that we released in March. And we'll come out with our Platinum Group yearbook at the end of July. And then there's this retail investor program, which provides lower cost entry into CPN Group's research and consulting services. The first question I want to deal with is, you said silver prices may soften going into the summer. Would you advise to go short on silver now with the expectation that silver prices will fall some? It really depends on who you are. If you are a facile short-term investor, you might want to short silver. But frankly, our view is that most investors should not be shorting silver now. Our longer term price expectations, which may be a question, it is a question that comes later. Our expectation is that silver prices will probably rise significantly from where they are today, $32, $33, over the course not only of this year, but through next year into 2027. And that's predicated on the fundamentals that Rowett just went through, the tightness of mine production, the slow increase that you'll see in mine production, fabrication demand trends, and investment demand trends. But it's also predicated on our view of global and regional and national economics and political developments, which anticipates a hostile economic and political environment for other assets and for people for the next 2 years at least. And in that environment, we expect investors will continue to buy a lot of silver and the price will probably rise. So unless you're really facile and ultra short-term investor, I wouldn't necessarily be shorting silver. Our expectation is that the silver price may soften. It already has softened from the first 4 months into May. There's some seasonality that kicks in. We also think that the financial markets will become inured to some extent to the chaos and uncertainty that the Trump administration generates with its constant changing of policies. I assume that Columbia and Harvard rue the day that they rejected him as an undergraduate student after he graduated from high school, because vengeance, some people just don't forget. But our expectation is things are going to be hostile. In that environment, we think that the silver price, quite frankly, might average around $32 an ounce over the next 5 months or so, pretty much where it is now. So shorting may not make sense. However, within the context of that average, those quarterly averages around $32, we wouldn't be surprised to see the price spike down to $29 or even $27.50. That's where it spiked down in the first quarter of this year. And we would advise our investor clients to buy if they have a time horizon, an investment horizon of, say, 1 to 5 years or longer. If they're longer term or intermediate term investors, buying at those spikes down, 29, something below 30, 27.50, probably makes sense unless the economic and political environment changes and thus our attitudes change. We're sort of like Don Maynard Keynes. When we learn something different or when the economic environment changes, we change our view accordingly. But right now, our view is if you saw the price spike down, might be a good time to buy if you are an intermediate to long-term investor. I wouldn't necessarily go short unless I was a day trader. Now, there's another question about silver price projections for 2025 and 2026. I told you our idea, which is that the price will trade sideways for the next few months, start to rise later in 2025, rise through 2026 into 2027, and rise on a more sustained basis than we saw in 1980 or in 2011. So that's that one. We have several questions related to the gold-silver ratio, and let me just deal with them. Gold-silver ratio increases. Do you think this is an indication that silver is losing its monetary appeal and turning into an industrial metal? Do you foresee a scenario where the gold-silver ratio would ever return to 50 or 60 level? So that's a couple of them. I think there's a third one. We don't think that the increase in the gold-silver ratio represents a decline in silver's financial role. We think it reflects an increase in gold's financial role. And there is a clear thing I mentioned earlier. Gold is universally seen as a financial asset that is a hedge against currencies, hedge against inflation, a hedge against uncertainties, hedge against political problems, financial market instability, both domestic and personal and international. Gold has a much more universal appeal. And what we've seen over the last several years, and really over the last quarter century, is an upward shift in the investment demand curve for silver. More people buying more gold for a longer period of time at higher prices than ever before, and in more parts of the world. There has been an increased ability to buy gold and silver, and in more parts of the world, when people see bad times, they run to the US dollar, US treasuries, and gold, and in some places, and to some degree, silver. Silver is seen more as a North American and South Asian investment. So the demand has been strong there, but it has been restrained by that offsetting sales, the disenchanted stable liquidation over the last 2.5 years or so. And it is less universal than gold. So it's not that people are losing their attitude that silver is a financial asset. It's that more people are focusing on gold than silver. And you've got that headwind there. In terms of where the ratio goes, I'm tempted to tell an old joke about of somebody asking God a question. Will there ever be a Jesuit Pope? And God says, sure, there will be, not in my lifetime, but yeah, sure. And then there was a Jesuit Pope. I think the ratio can go back to 60 relatively easily. But 50 may be a bigger stretch. And I may not see 50-1 in my lifetime. But the fact of the matter is that gold has gone through a much greater renaissance than silver. That's not to say that the silver price cannot rise and will not rise, especially if those investors that have been liquidating their holdings stop liquidating, which is really what you saw in 1979 and again in 2004, 2006. The big impulse that started the price of silver rising was investors selling less of the metal and waiting to see how high the price would rise before they sold. And that was the beginning of those two big bull markets. What is behind the typical slams on silver prices within the first few minutes of trading in the US, and how can we take advantage of them as a speculator? First off, do your math. The reality is that these periods of sharp declines in prices don't only occur at the beginning of trading. If you actually study the periods of time when you have outsized, third or fourth or greater standard deviation moves in the price of silver over a 5-minute period, as we have, if you actually study the silver price move, you'll see that there are a couple things that will shock you. One is that these outsized price moves, you call them slams, but that's a misrepresentation of what's going on. These outsized price moves occur all through the trading day, 24 hours a day. They do not cluster around the opening. The second thing is when you look at outsized price moves, you'll see that there are more outsized price moves to the upside than there are to the downside. You've been conditioned to only think about the big moves down. But if you were being a short-term speculator, you would have to re-educate yourself to understand that these moves go up and down. So it's not like someone's slamming the market per se, although you could say he's slamming it on the upside. The second thing is it's not a he or a her or an it. What you're seeing, not only in silver, because you see the same kind of trading occurring in gold and in other commodities and in equities and in bonds. What you're seeing is the effect of increased computerized trading. People are using computerized trading models that give the computer the thing, if you see X, Y, or Z, do A, B, or C. And you have an enormous percentage of trades on publicly listed assets, whether it's commodities or currencies or stocks or bonds. You see a very large percentage of these trades being generated by these computers. The computers look at the same price data and they use the same types of calculations to decide whether it's time to buy or sell. So that's what you need. If you really want to try to take advantage of it, get yourself a good computer and join that group of people who let their computers buy and sell when certain price moves trigger buying and selling. If you look at those periods of outsized price moves and outsized trading volumes, what you find is that it's hundreds and sometimes thousands of independent entities buying and selling within that same 5-minute period, right? And that's because they're all using the same computer. I pointed this out maybe 15 years ago at a silver conference, and someone in the audience said, so you mean the Fed has thousands of agents that will slam the market when it tells them to? I say, no. What I mean is that there are thousands of people who are using the same computer program, looking at the same price, buying and selling at the same period of time because the prices ticked higher or ticked lower. If you want to participate in that, you have to join that club. If you try to do it yourself, you'll lose. It's just that simple, right? I hate to say it, but that's where it is. Let's see what else we have. There's a question. Coin spreads have lately been rising to near levels near 20%. We don't see that. The coin spreads that we're looking at have actually come off in recent years and probably are much lower. We haven't seen a spike higher in coin spreads. What we have seen is a lot of retail dealers and some wholesalers being very resistant to buying anything other than good delivery bars or official coins, because there is this plethora of material out there, hundreds of millions of ounces of silver in coin form, in medallion form, in small bars. We've seen some really crazy things out there. And the dealers are saying, I am being flooded with this stuff being sold. I need to stop buying it. I just can't. If I understanding is correct, one of the most important factors to monitor will be the inflow or outflow of ETFs. This will affect directly the price of silver. ETFs are interesting to pay attention to, and it's different between gold and silver because what they do is they represent an easier, faster way to invest in gold or silver and to buy exposure to price changes. So what you'll see is, and you're seeing it now, investors saying, I want to buy gold and silver. And then they say, well, I actually don't necessarily want to own physical gold or silver, but I'd like to have long exposure to prices, or I'd like to have long exposure to prices. And you go and you say, okay, I don't have a futures account. I don't really know how to trade futures and options. And I don't have a physical account. But I do have a brokerage account that trades equities and bonds, and ETFs are equities. So I can trade those equities. So if you have investors who are not traditional silver investors who have established relations with either a physical retailer or a futures broker, they will go to ETFs. So when you see the ETFs flowing in and out, that represents that sort of soft money that comes and goes quickly, the followers. Oh, silver prices are rising. I should buy exposure to silver prices rising. How do I do that? The easiest and quickest way to do that is through ETFs, because if I try to open a futures account, it could take weeks or even months, given all of the regulatory hassles and the reduction in futures brokerage that is available to investors who have less than $50 million to invest in silver. So that's sort of where we are there. How would you expect a recession in the U.S. to affect silver demand? Well, it definitely will hurt fabrication demand. And quite frankly, our expectation is that it won't be a U.S. recession. It will be a global recession, and it will affect investment demand to some extent. If you look at the relationship between gold and silver prices in recessions, you see there's no clear pattern. In 1978-79, gold and silver prices rose prior to the recessions, which occurred in 1980, 81, and 82. If you look at the recession, perhaps more relevant and comparable to the current situation, silver prices started rising in 2005. They rose, the recession was from late 2007 into early 2009. So silver prices rose significantly for 2-3 years before the recession. They rose through the recession, and then they rose on the forward side of the recession. Silver prices rose from 2005 to 2011. There were other factors that were driving investors to buy more silver, 2005, 2007, and again 2009, 2011. So there's no fast rule. Oh, if you see a recession, silver prices will rise or fall. You can take the 1980 model and say, once we get into a recession, I would expect silver prices to fall. But I think a more relevant historical comparator would be the 2005, 2011. I think there's some fundamentals that go beyond recessions there. How long do you see this bull market lasting for gold and silver? That's a good question. We see, as I said earlier, we see it going at least into 2027 and possibly longer term. And then it also depends on what you call a bull market. In 2000, we said that the gold market was moving there was an upward shift in the investment demand curve, and that we were moving into a golden renaissance in which investors and then later central banks would rediscover the value of having gold in their portfolio. And they would later rediscover the value of having silver in their portfolio. And we issued long-term buy recommendations saying that we thought that the gold price would rise to unprecedented levels over the next several decades. And that was 25 years ago, and it's still going on. We wouldn't be surprised to see a cyclical peak in the rise in gold and silver prices at some point over the next 2 to 4 years. And then you could see prices come down. I was just looking, the price chart is at the very beginning. You could see prices come down for 3 to 5 years. I'm not sure how far down they would come, because I think you'd see a lot of continued buying. And then after that cyclical decline, you might see another leg up. So in other words, a pattern very similar to what we've seen since 2000, where you had gold prices start rising in 2002, silver prices in 2005. They both rose and peaked in 2011, although not together, silver in April, gold in September. Then you had about a 5-year decline from 2011 into 2015, 2016. During that period, you had this spike down in gold and silver prices in 2013. Prices moved sideways for a few years, and then they've been rising again, really, since about 2019. And we wouldn't be surprised to see that kind of pattern in the long run over the next 10 or 20 years. I think that's all we have in terms of questions. How long do you think this bull market will go? Here's another one. A lot of narratives have been spun recently about large short positions in silver ETFs. Do you think short positions are unusually large? And what do you see as the reasons for any significant increase in ETF short positions? I'm not sure that I see them as being unusually large, other than the fact that you have more people interested in silver ETFs than you used to. And I think what they represent is the fact that silver prices are extremely high compared to earlier silver prices. Silver prices have been basically above $30 this year. They've gotten up to $35 twice, once in October of 2024 and once in April, I believe, of this year. And we wouldn't be, I think what you're seeing with the short positions is that there are any number of people who are saying, silver is going too far too fast. I may be a long-term bullish, but the price could come down. Some of those short positions might be naked shorts, and i.e., people saying, I think the price is coming down, so I'm going to short the silver ETF. Some of those probably represent long investors in the physical market or the futures market hedging by going short the ETFs. It's hard to say, they don't admit what they're doing, but I do think that that's one of the things that's going on. So, when you have prices at close to historically high levels on a quarterly average basis, it's not unusual to see any number of people saying, this looks like a short. I think that's our last question. We've gone on for about 100 minutes now. So I'm going to wrap up here. You can go to our website. You can download and buy the Silver Yearbook. It'll be posted later today. And the Gold Yearbook is already up there. You can pre-order the Platinum Yearbook. You can order other research and consulting services that CPM Group has. And you can get some free reads and some free videos that we post there. You can always send us an email at info@cpmgroup.com and say you want to talk to us about ways that we can help you better manage your price exposure to precious metals and commodities. As I said, this week marks the 39th anniversary of the day I walked out of Goldman Sachs and created CPM Group. We've been around for a long time, longer than a lot of other people. We predate the World Gold Council. We predate the London Bullion Market Association. We predate those marketing groups that publish competing data. And we predate a lot of people who are actually actively trading in these markets. So we have a tremendous amount of experience here, and we'll gladly share it with you if you wish to become a client. That's all we have for now. Take care, and we'll be back with the Platinum Yearbook at the end of July, and we'll continue to post our twice weekly videos on YouTube whenever we want. All right. Take care. Bye.